Hello, I'm Monica Gibson, and joining me just now to discuss the potential implications of the ECB's monthly report is David Morrison, market strategist at GFT in London. Now David, the ECB said that some of the risks to the economic outlook it had warned about have materialised, thus damping inflation pressures and prompting policymakers to cut interest rates. Do you agree with this sentiment?
Yes, certainly. I mean, the situation in across the Eurozone, you can't say has improved to any measure. I mean, we're looking at really quite grim manufacturing and services PMIs. We're looking at terrible unemployment levels across much of the Eurozone, and specifically in the peripheral countries, of course. And more and more, it is quite obvious that very few countries are going to be immune from this, and we can see the sort of the stresses that we're seeing, not just at the peripheral countries, but the sort of moving now to core countries. When you think that Spain is the fourth largest member of the Eurozone by GDP, and Italy the third. So and of course Germany is not going to get away unscathed by this, despite the fact that German Bund yields are sort of at record low levels. Ultimately, there's a real danger of the whole Eurozone being affected. But I suppose that's sort of looking further out. They also did mention the fact that it should fuel prices spike higher. We've had a quarter where we've seen the price of crude come off very sharply, up to, I think we're talking about 20-30%. If that reverses, then of course we could easily see inflation start to tick higher again, despite the fact that we are in a deflationary environment.
Some analysts have advocated the ECB temporarily allowing inflation to allow debt-ridden countries to catch up to the core economies. But the ECB said that gains in competitive have to come from eternal economic reforms rather than it compromising on its mandate, and warned against high wage increases in the stronger parts of the common currency bloc. In this regard, which course of action do you think will be more effective for the Eurozone, David?
Well, again, it comes back down to the ECB's mandate, which, as it stands, is price stability, and again, there's this target rate of 2%. So, I think there's a real problem here in that it's doubtful, really, I think, whether if the ECB abandons that 2% target and sort of looks to allow inflation to run ahead. I mean, number one, I think that is dangerous. But number two, is that really going to be the solution to the problems that we have in the peripheral countries? And I mean, I think the problem is so serious that it's going to take other measures, and whether something like that might sort of ease pressures in the short term, well, it might well do. We're talking here about a fundamental shift. I think the danger of trying to sort of mess around with this inflation target is that you're going to have a bit of a schism in the ECB itself.
The euro economy will shrink 0.3% this year. The area's inflation rate will fall below the ECB's 2% ceiling in 2013, according to the report. Are these figures in line with your estimations? And if so, what effect do you think they'll have on the markets?
The outlook for the Eurozone economy is looking really quite grim. I would say that, sort of speaking, not just about Europe but globally, I mean, we look to be in a very difficult time, an era of very, very slow growth and maybe sort of recessions to come, and that looks like playing its way out as really the whole of the developed world has to get to grips with its over-indebtedness and actually start to deleverage more aggressively.
As we mentioned, the central bank urged policymakers to take action. The next time they will meet is on August 2nd. What do you think we should expect from this meeting?
Well, it's going to be a very interesting meeting for a couple of reasons. The next FOMC meeting, of course, comes on August the 1st. So August the 2nd, where we see the ECB. Now, from what we've heard from the FOMC, it sounds like the Fed are in no rush to provide more stimulus, and so it's almost like a tag team. You wonder now whether the pressure is all on the ECB. Now, of course, with Mario Draghi, he's been much more accommodative than his predecessor, and the first thing he did was cut rates and then, of course, launch two separate LTRO programs totaling £1 trillion euros. And I guess the pressure is now on him to announce something similar. Maybe, well, I'm not saying another trillion, but another round maybe of long-term refinancing operations. Whether he does or not, I just don't know. It's possible. That the big question then is that going to have any great lasting effect, and will it be enough to boost asset prices across the board?
David, thank you for joining me. Well, that's all we have time for at the moment. Click back for an interview from my colleague Thomas Taplin with Donna Yang from City Credit Capital in London. But for now, goodbye.